Investors digest Biden's plan, dollar regains control. U.S. stocks finished marginally lower on Tuesday as investor sentiment was affected by the resurgent bond yields and the persisting concerns over rising coronavirus cases in several countries. The yield on the benchmark 10-year U.S. Treasury note soared to 1.776% at one point before retreating to 1.717%. As a result, the S&P 500 slid 0.32%, the Dow Jones Industrial Average dropped 0.31%, and the Nasdaq Composite fell 0.1%. Asian equities were broadly lower on Wednesday despite solid economic data out of China. The country's manufacturing PMI came in at 51.9 in March, up from 50.6 in February, expanding to the highest level this year. Still, the Shanghai Composite shed 0.43%, while Japan's Nikkei 225 dipped 0.86%, and South Korea's Kospi lost 0.28%. In Australia, the S&P ASX 200 bucked the trend, adding 0.78% after data showing house building approvals hitting a record high in February. European markets finished lower as investors tracked rising bond yields. The Stoxx 600 ended the session down by 0.2% following 3 straight days of gains, while banks fell 1.2% to lead losses. Germany's jobless claims fell by 8,000 after rising by 9,000 in February versus forecasts for a fall of 5,000, while the Eurozone inflation jumped to 1.3% in March from 0.9% in February. In individual stocks, British food delivery firm Deliveroo tumbled 30% on its first day of trading as investors raised concerns with its gig economy model and high valuation. U.S. stocks rose overnight, closing out the month in the first quarter on an upbeat note as investors weighed President Joe Biden's big infrastructure spending plan that would see the corporate tax rate rise to 28% to fund it. The S&P 500 ended the session 0.4% higher after hitting a fresh intraday record high. The tech-heavy Nasdaq Composite popped 1.5%, and the Dow Jones Industrial Average slipped 0.3%. The 10-year Treasury yield traded flat on Wednesday at 1.73% after notching a 14th-month high of 1.77%. On the data front, private payrolls in March expanded at the fastest pace since September 2020, with employment rising 517,000 for the month. It was a healthy spike from 176,000 in February. Investors now await the March jobs report on Friday to assess the state of the country's labor market. President Joe Biden outlined a huge $2.3 trillion broad plan on Wednesday to remake the economy. As investors parsed the details of the spending plan, Asian stocks crept higher on Thursday, with the MSCI's broadest index of Asia-Pacific shares outside Japan rising 0.6%. In currencies, the dollar regained upside momentum following mixed trading on Wednesday. The euro-US dollar held above the 1.1700 figure, but failed to see a more robust recovery and turned lower again early on Thursday. German retail sales rose by 1.2% month-on-month in February versus plus 2.0% expected and negative 4.5% in the previous month. On an annualized basis, retail sales fell 9.0% in February versus a fall of 8.7% seen in January and a decline of 6.3% expected. The euro ignored the data and continued to trade marginally above 1.1700 as the US dollar regained control across the board. Oil fell another 2% on Wednesday amid a pessimistic demand outlook from OPEC and its allies ahead of their meeting to decide on production curbs. OPEC Plus revised its downward oil demand curve growth forecast for this year by 300,000 barrels per day, while the Joint Technical Committee made no formal recommendation ahead of today's meeting. Meanwhile, U.S. crude stocks fell 876,000 barrels last week as refinery runs increased, compared with analysts' expectations for an increase of 107,000 barrels. Crude output slipped to 11.1 million barrels per day in January, according to the latest monthly data. Brent was down 3.9% for the month and up 22.6% for the 3 months ended March 31st. After bouncing from $62.50, oil prices regained the $63 figure early on Thursday. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.